Good morning, everyone. Welcome to the TradeStation Masterclass. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. And for me, it's always a pleasure to be here. Today, we're going to talk about moving averages. So let me pull up the title slide here. The title is Switch Your Moving Average and Adapt to Market Conditions. So we're going to take a look at all the moving averages that are part of the TradeStation platform. Sometimes we go in there and a lot of traders just stick to what they know, to what they're familiar with. A lot of times we look at, simple moving averages, exponential moving averages, but sometimes we don't understand really the differences between them, or what are the other moving averages trying to tell us, the ones that are part of the TradeStation list of studies. So we're going to use the next, 30, 45 minutes to talk about the moving averages that are part of the TradeStation platform. Before we get started, the usual disclosures, just keep in mind that every symbol and idea that I talk about is for educational purposes only. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and that past historical performance is no guarantee of future results. For additional information on these disclosures, go to www.tradestation.com/important-information. All right, let's go ahead and get started. So let's talk about moving averages. Before I get into the moving average exponential, let me go ahead and switch over to my TradeStation platform and set up my chart. Let me just get rid of my notifications here at the bottom. I'm going to click apps and click on chart analysis. Okay. And let me resize this. This is a daily chart. Actually, this is the 5-minute chart of Apple. It's okay. Let's just leave it the way it is. And I'm just going to go to the studies button here at the top and click on add study. So what I'm referring to is all the studies that are part of the collection of moving averages. If you scroll to the M's, you're going to find that you have, the common moving average, 1 line, 2 lines, 3 lines. But then we have something called adaptive. We have something called DEMA or DEMA, envelopes. We have exponential moving averages. We have whole, MAMA, KEMA, TEMA, triangular, volume weighted. So there's a lot of different moving averages that you can use. So today we're going to talk briefly about each one of them, and in some areas, how you can convert some of these moving averages into strategies. Because one thing that I've found is that whenever I do research on these moving averages, of course, there's a ton of information out there. You can just type in one of these names into a search engine, and you'll get article after article explaining how these averages are calculated and how they're interpreted. But one of the things that I found too is that some of them say, oh, this is a better moving average than just a simple moving average, which, I tended to want to test that myself. I want to make sure that whatever it is, whatever it's stated out there, that I can, use my TradeStation platform to put it into a test and see if it's true or not. We do have the capability of turning any of these indicators into a strategy and measure how the strategy signals behave. One of those, moving averages that I tested was this one, I think, MAMA. I heard a lot of great reviews online that said, oh, this is a great indicator because it adjusts to market conditions and it adapts automatically. But, I did some preliminary tests and I wasn't really impressed. And then we're going to talk about those, and I'm going to show you how to turn any of these indicators into a strategy so that you can also do the back testing yourself. So let's get started with a simple moving average. 1 line, click OK. All right, this is my 1 line moving average. Let me go ahead and open up my spacing here on the chart. By default, the 1 line moving average uses 9 periods, and this is a straight, simple moving average, meaning that if it's a 9-period moving average, it'll take the closing prices of 9 bars, add them together, and divide the results by 9. Simple moving average. Let me go ahead and modify this moving average, and I'm going to turn it into a 30-period moving average, just so that it gives me a smoother line and in some areas, it removes itself a little bit from the candles. And that way we can get a better picture of what this indicator is doing. In addition to this indicator, let me go to studies and add study. And by the way, the ones that say 2-line and 3 lines are just there for you to have multiple periods for the moving average calculation. If you're following like a 30 period and a 50 period and a 100 period moving average, instead of adding the moving average 1 line 3 separate times, you can just use the moving average 3 lines, and then you have, the ability to adjust the inputs for each one of those moving averages. But they're exactly the same calculation. It's just the number of lines that are inside of the moving average. But if I click here and I select something like an exponential, you see, exponential, we have, the exponential 2 lines, the exponential 3 lines, and we have the exponential ribbon, which are all exponential moving averages. The moving average exponential is just one single line on an exponential calculation. So it seems like there's a lot of different moving averages, but it's just the number of lines that are plotted with the study. I'm going to click on moving average exponential, click OK. And let me go ahead and double click on that line. A lot of times what I like on my TradeStation is to make these lines a little bit thicker. By default, I find them to be very thin. So let me change the default to that. And I'm going to go to the inputs here of this exponential moving average and turn this into a 30. All right, so that's my exponential moving average. What is the difference or the main difference between an exponential moving average and a simple moving average? Well, an exponential moving average will provide more weight to recent data. When we did the calculation on the simple moving average, we took all the periods, we added them together, and we divided them by the total number. In an exponential moving average, the data points that are closer to right now will be given more weight. And that's the reason why we have a moving average that's a little bit more responsive than the simple moving average. We see in today's trading activity, this is Apple, by the way. Today, there was a gap in the opening of the market. Yesterday was a trading day, right? Yes. So yesterday, Apple closed at 185, and this morning, it opened at 183. So it was a slight jump, and we see a gap right here. Well, notice what happens to the moving averages. The cyan line, which is my simple moving average, takes longer to respond, whereas my red line, which is my exponential moving average, is quicker to respond. And you see an effect of that drop in price, how it affects the line faster on that red line than it did on that cyan line. And that's the concept of an exponential moving average, that it is more responsive to recent data. Let me go over here to my PowerPoint and talk a little bit about the components of the moving average. A lot of times I go into the insides of the moving average or any technical study for that effect, and understand the math and understand the intricacies of the indicator and how it's calculated, and why is it that I see a value like the one I'm seeing, and why is it different than another indicator. I do a lot of that comparison because I like to understand everything about the indicator before I even start using it. There's a good thing about understanding the mechanics and the intricacies of an indicator before you use it, because it gives you a full understanding on how the indicator reacts when it faces market activity, and why is it responding a certain way. In an exponential moving average, we have something called a smoothing factor. And of course, the smoothing factor is going to give more weight to more recent data points. The smoothing factor, and a lot of the math may not, matter to you. What matters most is how to use the study and how well is it able to identify, those entry and exit points. But a lot of times it's good to look at the math too. So we, in this PowerPoint, I do talk a little bit about math and how these plots and lines are calculated. The smoothing factor is the number 2 divided by the length plus 1. That's how the smoothing factor is calculated. And the moving average exponential is going to take the closing price of the bar. It's going to subtract the previous bar's average, multiply the result by the smoothing factor, and then add the result to the previous bar's average. That's exactly what the moving average exponential does. And this smoothing factor is the mathematical calculation that provides the more recent data, the more weight necessary to make, the moving average a little bit more responsive. A lot of times, if you're interested in how this formula is laid out inside of the exponential moving average, one thing that I do a lot is open up the easy language code. In fact, a lot of these formulas that I put here in this PowerPoint and PDF are taken from easy language. Let me go back here to my TradeStation, and a quick way for you to jump from an indicator to its easy language is by just right-clicking on its line. So right now, I'm just right-clicking on the red line and clicking Edit Easy Language for Moving Average Exponential. It opens up the code. All right. This is the code for the exponential moving average. You can see the tab right here at the very top. And what I was talking about is math. Now, from a lot of these indicators, by the way, are built also with the help of a function. So looking at this indicator right now, I don't see the math that I just spoke about, the smoothing factor and the fact that you have to take a number 2 and divide it by the length plus 1. You don't see any of that here because that calculation is part of what we call a function. By the way, for those of you that are not familiar with what I'm showing here, this is easy language. This controls every technical indicator and every technical strategy of TradeStation. So if you want to modify or if you want to understand any of these studies or strategies, a little bit of knowledge on easy language is great because you're able to understand, how the indicator calculates, and better yet, you're able to modify its calculations if you feel like you want to edit something. So I do encourage anyone that is interested in customizing indicators and strategies to learn a little bit about easy language because it's going to take your analysis and trading to that next level. So in here, a little bit about easy language syntax. You see a word that is in purple. This is a function. It's called X average. And if I right click on that function, I'm able to open the function. A function is like a snippet of easy language. So we are using easy language inside of easy language. It's kind of interesting, but I have the ability to open up the function. And this is where I see the actual math. So here's where I see the smoothing factor calculated. And here's where I see the formula, the 2 divided by the length plus 1. So all those statements that I have on that PDF are probably taken from the easy language code. So feel free to go in there, open it, and see the math formula. A lot of times it makes more sense to see it in a formula format than it does on text, like I have it on the PDF. But here is the remaining formula. It just takes that X average. It adds this multiplication, which is a smoothing factor, times the price minus the average of the previous bar. By the way, anytime you see the square bracket and a number inside a square bracket, that is just a historical reference. So that square bracket 1 that you see right there for the X average is just referencing the exponential average or the exponential moving average of the prior or the previous bar. Okay, let me go over here to my chart and we see the difference between the two. We already pointed out that this red line is a little bit more sensitive to price action than the cyan line. And we see that not only on today's trading activity, but we see it consistently. Like, for example, over here when Apple dropped significantly on these couple days, January 2nd and January, this is January 2nd. This is not multiple days, this is just one day right here. So there was a huge drop in price, and you can see how the red line was a little bit more responsive than the cyan line. Let's go over here to my PowerPoint and go to the next moving average. Let's talk about the moving average adaptive. By the way, that's also available in your list of built-in studies. Adaptive moving average was developed by Perry Kaufman, and it's called KAMA, K-A-M-A, is sensitive to price changes and will follow the price closely when price swings are small and noise is slow. I like this indicator a lot. By the way, a few years ago, I did a whole class on comma because I found the indicator to be very interesting. It's the name, it pretty much implies that it adapts to market conditions. There's a couple moving averages in the list of studies on TradeStation that do that very nicely. Depending on how volatile the markets are, the moving average will adapt automatically. And this is one of those studies. It calculates an efficiency ratio, which is defined as the price change adjusted for the daily volatility. And this is a very simple calculation. Let me see if it's, yeah, okay. So this is how it's calculated. It takes the difference between the close and the close of a certain number of bars ago and divides it by the summation of price change from bar to bar. That's called an efficiency ratio, because one thing is for you to know what the difference of one price is compared to a price in history. So we know exactly what the difference is by just subtracting one from the other. So if the current price is 10 and that historical reference is an 8, you know that the difference is 2. But anywhere between that 8 and that 10, the price could have gone to different extremes. It could have gone to 12, it could have gone down all the way to 2. So that volatility that happened between the 8 and the 10 is not reflected in that straight difference. Yes, the difference is 2, but what happened in between? You could have had price swings of 4 or 5 or 6 points. So this is exactly what that efficiency ratio does. It calculates not only the difference between point A and point B, but also measures that against what happens in between. What are the price changes from bar to bar? And that's exactly what this formula is trying to represent. And that's what the efficiency ratio does. With that efficiency ratio, the indicator is going to do its calculations and adapt. If there's a lot of volatility, it's going to try to use a higher time frame to smooth the moving average a little bit more. Whenever there's less volatility or the markets are kind of moving sideways, then the indicator will adapt and they will use a slower time frame in order to stay closer to the price bars. Very interesting calculation. By the way, again, the moving average adaptive indicator is something that you guys can open up within the TradeStation platform and look at its code. Let me show you. Let me first of all add it here to the chart to see how it compares to the simple, the exponential, and now I'm just going to add the adaptive. So let me go here to moving average, adaptive right here. Let's go ahead and click OK. Again, the line is pretty thin, so let me go ahead and format it. The style, and I'm going to make it thicker. And the inputs, we have the efficiency ratio length, fast average, and slow average. It's interesting that this indicator, and this is one of the things that I talked about in that very detailed class that I did on this study. You're pretty much specifying the two extremes. You have a fast average set at 2, and then you have a slow average at 30. The indicator in its calculation is going to range that periods from 2 all the way to 30 based on the efficiency ratio, the volatility that you are calculating as part of that study. Let me go ahead and click OK. This is calculating the efficiency ratio. It's going to be hard to compare this study to the simple and the exponential average we have already on the chart, for the reason that this study doesn't use a fixed length. It uses a variation between 2 and 30. But I'm going to leave it as it is. I'm going to click OK and take a look at the study over here. If we look at how responsive this indicator is, of course, it's a little bit more responsive than what the exponential moving average is. I want you guys to take a look at something. You can see that when the prices are kind of flatline, you can see how close this indicator is to the candles. Not even the simple and not even the exponential moving averages are able to get so close to the candles. And that's all because of the calculation of that adaptive moving average, that when there's high periods of volatility, it uses higher periods in the calculation. And when there's little, volatility, it's just going to come down to the lower extreme of that range, which is at 2. I think the default is a 2. As I said at the very beginning, there's so many different interpretations of moving averages that it's really hard to say. I mean, I can sit here and say, hey, this is better than the other one. But the fact that TradeStation provides you so many different types of moving averages for you to discover the one that fits your trading style. A lot of times, it's all about how you are interpreting and how you are using them. As I said before, one of the indicators that I found some comments on and on the web, they were praising the indicator because it was highly adaptive and it was just responding to market conditions. And then I tested it against the exponential moving averages, and I wasn't really getting that good results. So let me show you how you can do that testing on your side. Before I do so, let me just get a little bit ahead of my PowerPoint here. And that way we can concentrate on how to do the testing and how to do the modifications of those studies. This is DEMA. DEMA is an interesting type of moving averages. It uses 2 exponential moving averages. So it calculates an exponential moving average of an exponential moving average. Makes it a little bit more responsive than just a straight exponential moving average. It was introduced by Patrick Molloy in 1994, and it attempts to eliminate lag by making it more sensitive to recent data points. Increased sensitivity may not always be a good thing, since lag may help filter out noise. If your indicator is way too sensitive, it's going to respond to the ups and downs of the markets. It's going to respond to noise. And we know what happens when you have an indicator responding to noise. You're going to get a lot of false signals. So even though sensitivity sounds like something you want your indicators to have, sometimes you have to strike a balance between sensitivity and lag, because that's a way that you find an indicator that works and that adapts to market conditions in a more efficient way. So DEMA is or was created for that purpose, to make it a little bit more sensitive than just a regular exponential moving average. And there's a little bit of the math here. I'm not going to go into the math of the DEMA, but I am going to put it on the chart so we can take a look at it. So let's go over here to my chart. Let me remove the yellow one, which is the adaptive, and I'm going to remove the cyan one, which is the simple moving average. I'm just going to leave the exponential moving average, which is the red line, and I think I set it to 30 periods. I'm going to go to the studies and add studies, and I'm going to choose moving average DEMA. This is a double exponential moving average. That's what the acronym stands for, DEMA, double exponential moving average. I'm going to click OK, and I'm going to double click on that line. I'm going to set it to 30, just as my regular exponential moving average. And I'm going to change the style here to a thicker line. There we go. Take a look. I mean, there's no explanation needed. You can see that it's more responsive than the red line. Of course, it stayed closer to the candles on Apple, but on the gap, notice what happened to the yellow line. It crossed under the red line, and now it's touching the candles. It touched the candles earlier than the red line did. I mean, the red line is touching the candles right now, or, there was a crossover a couple bars ago, but the yellow line did it faster. And the reason for that is because it's a double exponential moving average. If I look at the formula, let me right click on this indicator and go to the easy language. All right. Notice that there's a function called DEMA. And if I right click on the function and I click on open the function, notice that we have the 2 exponential moving averages. These 2 functions is what calculates the exponential moving average. So you have an exponential moving average and then exponential moving average 2. And then DEMA just takes those 2 and does this formula where it takes, the first exponential moving average, it multiplies it by 2, and then it subtracts the second calculation of that exponential moving average. So anybody that's looking for the details on the math, you can just open up the code and take a look at the math that is in there. In addition to the double exponential moving average, this is DEMA, double exponential moving average, we have TEMA, which is a triple exponential moving average. And then you have the formulas in there. We're going to take a look at those. And then in addition to TEMA, we have a QEMA, a QEMA. This is a quadruple exponential moving average. Okay, I'm going through the moving averages, not in the exact same order that the studies are listed inside of TradeStation, just because I think these four studies need to be explained together. The exponential, the double exponential, the triple exponential, and the quadruple exponential, they're all related because they are all using exponential calculations. What varies is the number of exponential moving averages that are used. So yes, a quadruple exponential moving average is an exponential of an exponential of an exponential of an exponential. That's pretty much what it does. And if I go over here to my chart, let's go ahead and compare them. I have my exponential, which is red, and I have my double exponential, which is yellow. Let me go to studies, add studies. Let me add the triple. Where's triple? See, in the list of studies here, they're in alphabetical order. So you have to look for TEMA, and I'm going to do the Q2. Let me prompt for editing and then click OK. So let's see. This is the quadruple. Let's make it thicker. The inputs, I'm going to make it 30 as my other indicators. And the color here is going to be this purple color, okay? And the other is going to be a cyan. Let's make it thicker. And in the inputs, I'll make it 30 as well. Here we go. This is what we see on the chart. From the beginning of the day, we can see the one that dropped the fastest. That was the purple line. And the purple line, the purple line is the quadruple, the 183.59. That's the one that dropped the fastest because of that calculation. It's 4 times the exponential moving average. So let's go over here, and you can already see that in the recent candles, we can see how this little uptrend that is developing right here for Apple in the last several candlesticks, you can see how the purple moving average, or this exponential moving average, is getting closer to the candles as they go up. So it is very responsive to market activity. Yes, I see your comment, Michael, and I do have to agree. In terms of what Michael is pointing out, the complexity of the moving average, these comma and other indicators use very intricate mathematical calculations. And a lot of times even, I mean, I'm going to be honest with you guys, I'm I'm not, I'm not a mathematician to understand a lot of those calculations that are happening. We're going to take a look at one of those studies that does a lot of advanced math, but the fact that they're doing, or the fact they're using more advanced math doesn't make them better than just a simple or an exponential moving average. I've done, many tests on TradeStation comparing the performance of different moving averages. And, to tell you the truth, I've realized that a lot of the better results are generated by simple calculations. Not to discredit, those advanced calculations either, because they're there for a reason. We provide those studies as well. And every symbol that we apply the study to is always going to provide you different results, because every symbol has a different market tone. Every symbol behaves differently and responds to market conditions differently. So you may find that some markets do, behave well or do respond well to certain type of moving averages. So these are the 4 variations of exponential moving averages: the simple, the double, the triple, and the quadruple. Just wanted everybody to see them in one place. In addition to those, let's go back here to my PowerPoint. This is MAMA. This is the one that's developed by John Ehlers. And it's also called MESA. This is the one that I was talking to you guys about and said that it was advanced math. And we're going to take a look at the easy language code. And I'm not sure if it's going to happen to you, but when I opened up the code, I said, well, this is way over my head. Well, it's called MESA, adaptive moving average, also because MESA stands for maximum entropy spectral analysis. I'm not even sure if I'm pronouncing that correctly, but you can already tell that it's a more advanced calculation. In its formula, it's using, two plots. One is called FAMA, the other is called MAMA. But at the bottom bullet point, it says that this indicator adapts to price movement based on the rate change of face as measured by the Hilbert transform discriminator. This is not something that TradeStation came up with. This is just math and a method of calculation that exists out there. Maybe we have some math enthusiasts here in class, and maybe you're familiar with some of its calculations, but I wasn't. So when I looked at the code, I said, this is way far, over my head. But it's interesting that we are able to open it up and see all the intricacies of this indicator. The nice thing about this indicator, and I say the nice thing because it claims to do something for you, which is it responds and adapts to market conditions. As a volatility increases, the indicator is going to respond to that. If volatility drops, this indicator is going to respond to that as well. Let me go over here to my TradeStation. I'm going to go to studies and add studies, and let's add, a rocket scientist. He must be, because I mean, this indicator is impressive when it comes to calculations and easy language code. So let's go over here, moving average, MAMA. All right, this is some of the inputs that are part of that indicator. I'm not going to change anything. I'm just going to click OK. And let me remove some of the other lines because it's getting kind of cluttered here, because I want you guys to take a look at how this indicator looks on the screen. I didn't change the style, so let me go ahead and do that very quickly. Just change the thickness of the lines. Okay. And you can see the look of this indicator. It has a stair kind of look where it's not as smooth as the simple moving average or the exponential moving averages. And the reason for that is because it is adapting at every, what they call ratchet. It's just changing some of the parameters that are used in the calculation, and it's shifting at that specific point where you see this stair changing. It claims to be very responsive to market activity and volatility. One of the things that I did is I turned this indicator into a strategy. So let's talk a little bit about how to turn any of this indicator into a strategy so you can do some testing. TradeStation provides some strategies on simple moving averages and exponential moving averages. And let's compare the results of one of those strategies with this one in particular. Oh, I wanted to show you the code. Let me right click on one of these lines and go to edit easy language for MAMA, or moving average MAMA. Let me sure if it's set that way, the MAMA. I just call it MAMA because it says MAMA, right? And over here, we have the code, which doesn't seem that complicated until you go in here into this function called MAMA base. I'm going to right click and say, open the function MAMA base. And then it opens this function. Hold on. Okay, there we go. It opens up this function, and then that's where we start seeing some of the more advanced mathematical formulas based on that, method that we mentioned in the PDF or PowerPoint. So let's go back here to TradeStation and compare. What I did is I went over here to the code. Let me go back to the code. I didn't do anything with the function because I'm just going to leave it the way it is, but I did open up the code. This is the MAMA indicator. And what I did is, and you can do this with any study. I'm going to go through several steps of modifying an indicator, removing some of the things that are not needed in a strategy, and just focus on the signals that are going to generate the buy and the sell. What I did is I copied all the code, Control A, that just highlights everything. I do Control C to copy the code. And then I went over here to my new drop down, and I'm clicking here on strategy. This strategy that I'm creating is, I'm going to call it moving AVG Mama. And just so that I know this is a custom strategy, I'm just going to provide my initials at the very beginning, JN, and add an exclamation so it sorts to the top. And a lot of times, I do that just to make sure that I differentiate the built-in strategies for the ones that I write myself. I'm going to click on OK, and then I'm just going to do Control V as in Victor to paste. So I've just pasted all the code from that indicator here into the strategy. Well, from the bottom, let's start from the bottom. Let me remove this copyright. I don't need it. Alert enabled and alert condition. This is probably what I need in order to generate the signals. Mama crosses over Fama. So I'm going to leave it here for now. This section that says if alert enabled. Over here, though, it says if in a chart equals false. So there's indicators also designed for you to use it inside of radar screen, which I'm not going to do on a strategy. You cannot put a strategy into radar screen. So this whole section that if in a chart equals false, I can remove. So line 64 all the way to 82, I'm going to remove that. I'm going to scroll up. I don't need these alert conditions, and I don't need this note. I don't need this pound region. All I need is, it's the crossovers. So let me go ahead and see. One thing that I need to remove is anything that references plot statements. In an indicator, of course, you need plot statements because you need something that draws the lines on the chart. But on a strategy, I don't need them. In fact, if I try to verify the code, let me try here. Let me try to verify it. It's going to, well, now it's going to give you an end region. It's highlighted end region because I removed the begin region. I don't need this. Let me remove that and verify. So notice how it highlights plot one. It doesn't allow me to use the word plot one in a strategy because the strategy doesn't plot. The strategy only generates buys and sells. So I'm going to remove all this block of code right here. So it's simplified more. Let me remove this note here. And this gets information that it's on a chart. Yeah, this is fine. Let's leave that there. This is the calculation on stabilization delay. Let me leave everything else the way it is. And then I'm going to do the following. Instead of alerting when the mama crosses over Fama, I'm just going to buy. I'm going to say buy next bar at market. And then let me remove all this too. I just need the condition. So if Mama crosses over Fama, buy next bar at market. I'm going to copy this and do the other side. If Mama crosses under Fama, then buy. This is a sell short. Sell short next bar at market. Okay, let me verify this. And you can see that it verifies successfully. So I was able to strip the code of anything that I didn't need or the strategy didn't need, and then just concentrated on the signal. On the indicator, it was the alert. The indicator generated the alert whenever there's a crossover. I'm using that same alert, which is the signal, to generate the buy and the sell short. Let's go ahead and add the strategy to my chart. Studies. Add strategy. And I called it exclamation JN. So let's go ahead and look for it. And this is a moving average mama right here. Exclamation, that's what I called it. Exclamation JN, moving average mama. I'm going to click OK. All right. And we see the strategy working for us. And this crossover that happened today, where the fast crossed under this low, we have a short entry. Now the market recovered and we had a crossover just a few bars ago, and now we're long. But you can see that the strategy is responding to those crossovers and generating the alert. This is Apple on a 5-minute chart. I'm going to load 6 months of historical data, and I'm going to generate the strategy performance report. Let me pull up a daily chart instead. On a daily chart, this is what the strategy performance looks like. All right, we have a net profit of $4,000. This is in a period of 5 years. You can see that up here on the title bar of the strategy performance report, my back test goes from 2019 to 2024. So let's keep these numbers in mind, because I'm going to switch the strategy to something like a simple moving average. So this is Mama. Let me go over here and take a look at the inputs. So the fast limit 0.5. Yeah. Let me just leave it the way it is right now. And I'm going to put in a 2-line strategy. Let's go here to studies, add strategies. Let me look for moving average. Oh, the M's are down here. Moving average cross, the 2-line cross LE with the 2-line cross SE. Similar to what's happening to Mama here, we have 2 lines that are crossing and generating long entries and short entries. Let me go ahead and put those in. But what I'm going to do is I'm going to disable Mama. So let me go here to studies, edit strategies, and let me turn the status of my strategy off and just leave the moving averages. I'm going to click OK. And you can see that my net profit slightly improved. And my profit factor, I didn't really pay attention to what it was earlier, but I think we had an improvement also. Let me double click on one of these arrows. Let me turn off Mama, and turn on Mama and turn off the other 2 strategies. So there is a slight improvement on my profit factor when using just simple moving averages. So I was really, the truth, I was a little disappointed at using this strategy, because I thought it was going to provide better results, and it didn't. And you as a TradeStation client, of course, have access to all these advanced tools in order for you to do that type of testing. Of course, an indicator may claim that is a little bit more responsive and adaptable and responds to market conditions, but when you do the actual testing, that's when you realize exactly what the behavior is. All right, so I did this a little bit on this indicator. You can do that on any of the others, and feel free to test any of those ideas as a strategy. Let me go over here to my PowerPoint. This is the moving average envelopes. This is an interesting indicator where it measures a little bit of the volatility extremes. I believe it's a simple moving average. It is a simple moving average, and then it calculates a percentage above and below the market. If you put it on a chart, let me go ahead and open up a new chart here. Be easier than clean out the one that's there on this workspace. So let's go here and go to studies, add studies, moving average envelopes is in alphabetical order, envelopes. You can see that in the inputs, you have a percent above and you have a percent below. In this particular case, we're using 1%, but the calculation of the moving average is a simple moving average by default set to 20 periods. And this is what it looks like. It just creates a channel around the bars based on a 1% movement above the simple moving average and a 1% movement below the moving average. So very straightforward, very simple calculation. The moving average ribbon are exponential moving averages at different lengths. And what traders can do is determine the strength of a trend by looking at the distance between the moving averages. When the ribbons expand, it indicates a strengthening trend. But when they contract, or cross, it may indicate a pullback or reversal. So the moving averages, again, they're using exponential moving averages. It's a pretty looking indicator. Studies, sometimes I say it's not so much, how good the indicator works, is just how cool it looks on your TradeStation platform, right? When you look at the exponential moving average exponential ribbon, and just click OK. I'm just going to use default parameters. You can see the look of this indicator. And it's just a set. In this case, how many? 3, 6, 8. There are 8 different exponential moving averages that are incrementally, they're incrementally calculated. And you can see that how when they expand, or the distance between the averages is bigger, you can see that the trend is a little bit more significant. When they get closer is because the market is pretty much moving sideways. So an interesting way of looking at the exponential moving averages as well. And let's see. And we have the moving average weighted. I think this is the last moving average, when we have a few more. The weighted average uses the length to multiply the value of the average by how many bars back you're looking. And it uses the highest numbers towards the front or the more recent bars so that it gives more weight to those bars. So in comparing the calculation, this is very similar to an exponential moving average, where the more recent data points are given more importance. That's exactly what this does. So let's compare the moving average weighted with the exponential moving average to see how they compare. Which one is more sensitive than the other? Let me go ahead and kill this ribbon. I'm going to go to studies, add studies. We have the exponential, moving average exponential, and I'm going to compare it to the moving average weighted. I'm going to set both to 30 periods, 30 trading days. So this is the weighted, and the weighted is going to be cyan. All right. So the cyan moving average, this is the cyan is the moving average weighted. It's a little bit more sensitive than the regular exponential moving average. Very similar in the way they're responding. You can see that if I squeeze my chart, the two moving averages kind of follow each other very closely, but one is a little bit more sensitive, and that is going to be the volume. The moving average weighted indicator is a little bit more sensitive. And the reason why it's more sensitive is just because of the mathematical formula utilized. It's not just because it's so much more different than the other. The concept is exactly the same. We're just giving the more recent data more weight, and in this case, the moving average weighted, it's more sensitive. The average Hull has the name of its developer, Alan Hull, in 2005, and it attempts to minimize the lag of traditional moving averages while retaining smoothness. Though you're already telling that many of the technical analysts that have attempted to create a variation of the moving average, they're just trying to do the same thing. They're trying to strike that balance between responsiveness and lag. We don't want to make our moving averages so responsive that it generates false signals back to back, but we don't want it to be so lagging that we're missing out on great turning points of the market. So I like the idea of having those moving averages that adapt to market movements. A lot of the simple moving averages and the exponential moving averages and the weighted moving averages have a fixed time period or a fixed calculation parameter, and it doesn't change. You have to go in there and change it manually. Some of the moving average calculations, like the comma moving average or the mama moving average, that claim to adapt automatically by market conditions, seem to be a very interesting concept. But I do encourage everyone to take those indicators and test them to see if they prove to you that they're providing better results. We have the moving average triangular. which is an interesting way of calculating moving average. It's interesting that this one provides the weight not to the most recent bars, but it provides the weight to the middle portion of your look back period. So it's interesting because usually what we want is to give more importance to the recent data points, but this one in particular doesn't do that. I mean, the simple moving average provides the same weight across all the data points. The exponential weighted average and all those similar type of calculations provide the weight on the more recent bars, but this one over here just provides the weight on the middle. That's why it's called a triangular type of moving average. The recommendations on this indicator, let me see. It gives weight to the middle section of the data interval. It has significant lag to current prices and is not well suited for fast moving markets. Fair warning, because if you're giving the most weight to the middle of that period, it just makes it more lagging in terms of what is doing on current data. And the volume weighted, I think this is the last one. Yeah, this is the last one. The volume weighted is also a very interesting calculation because not only is it looking at price, it also looks at volume. And in a average calculation, it'll provide more weight to those data points that have the most volume. So let's go ahead and do one last comparison here. So let's leave the weighted, which is very responsive. We already determined that the volume average weighted was a little bit more responsive than the exponential moving average. But I want to compare, this moving average weighted with the moving average volume weighted. Let's go over here to studies, add studies, moving average volume weighted. And let's turn this into a yellow and let's make it thicker. Okay, let's make that a default and just click OK. Take a look. Okay, we didn't change that parameter though. Let's see how many periods this indicator is using. It's using 9. Let's do 30 to match our volume weighted. I'm sorry, to match our moving average weighted indicator. All right. The movement of this indicator, you can see that is a little bit odd compared to other moving averages. Is not as responsive to data as the cyan, which is just a straight moving average weighted. But again, the calculations here are different because the yellow line is sensitive not only to price, but it's also sensitive to volume. So if you go here to studies and add studies, and I add just a regular volume study, we are going to identify areas where whenever there's high volume, you can see how this indicator gets really close to those candles. You see, at the beginning of the day, we had a huge spike of volume, and you can see how close it got to the bars because that's the bar that received the most weight in the moving average calculation. Today, when the market opened, we didn't see as much volume as we saw yesterday. In fact, at this point, we see a decrease in volume activity, and you see what effect that has on our line. So these are some of the moving averages that I wanted to talk to you guys about. There are a lot, and as I said during my class, I want you guys to test. I want you to take them, open up the code, turn those indicators into a strategy, do your due diligence in determining which one is the one that fits your trading style. But this exercise of putting those indicators on the chart, comparing them and see how they're responding to market conditions is going to be an eye-opener because you're going to see which one responds better to what is it that you're trying to achieve. And also, by turning them into strategies, you're able to have a little bit more confidence, on those moving averages that you're using for strategy signals. All right. Thank you guys for joining me today. Look at the events calendar. We have upcoming classes in January and February. Make sure that you join us. We have some new options classes available in the calendar as well. Make sure that you check those out. We are developing a whole educational series around options. So you're an options trader. I encourage you to look out for not only those webinars that are posted already on the events calendar, but also any emails or any type of documentation that we're going to make our clients, that we're going to make available to our clients in regarding options trading. And I'm referring to equity options and index options. Okay, so check out the events calendar. I look forward to seeing you in a future event. And everyone have a wonderful afternoon. And thank you for joining me today. Goodbye.